Good evening and Happy New Year, everyone. Tyler's off tonight. Well, champagne on Wall Street was flowing today as the Dow and the S&P 500 ended the year with another round of new record highs. 2013 will be remembered as the longest bull market winning streak since the 1990s. The Dow posted 52 record closes and the S&P tacked on 45 new highs. Here's a look at the scorecard for the major averages for this last day of 2013 and for the year. The blue chips jumped 72 points today, reaching 16,576. That's a new milestone. The Nasdaq added 22, closing at a fresh 13-year high, and the S&P rose 7 points to 1848. For the year, the Dow surged 26.5%. The Nasdaq skyrocketed 38%, and the S&P soared almost 30%, its best year since 1995. Looking at the sectors of the S&P, all 10 rose in the past year. Consumer discretionary stocks did the best. They were up an amazing 41%. Now, the biggest winner on the S&P was Netflix. Its stock almost quadrupled, rising 297%. The biggest loser, Newmont Mining. It plunged 50%. Over in the commodities markets, gold lost its glitter in 2013. The precious metal tumbled 28% for the year, closing at $1,201 an ounce. That's its worst year in more than 3 decades. But oil prices rose 7% this year, closing at $98.62 a barrel. So now that we've closed the books on such a sensational year, what's in store as the calendar turns the page to January? As Dominic Chu reports, Wall Street history shows January is usually a good month for the markets.
2013 was a great year for stocks, and if history is any guide, 2014 could at least start off with more positive momentum. The number crunchers at Bespoke Investment Group found that over the last 100 years, the Dow has averaged a gain of over 1% in January and is positive nearly 2 out of every 3 years. Paul Hickey of Bespoke says the numbers are even more positive if you look at a broader measure of stock performance like the S&P 500.
January is typically a seasonally strong month of the year. In the last 20 years, it hasn't been as positive, but when you look at strong years like we've had, a 25% gain, in prior years where we've seen that, the S&P has actually averaged a gain of about 2.5% with positive returns over 80% of the time.
So, stock bulls like the odds of a positive January. Now, speaking of the S&P 500, we took a look at what sectors tend to have good January runs. During the more recent bull run over the last 3 years, investors have liked the cyclicals, the stocks that are more tied to the ups and downs of the overall economy. On average, over the last 3 Januaries, industrials, financials, and energy stocks have done the best as investors have bet on a recovering U.S. economy. They're all up around 5.5% for the month on average during that time frame. The worst performing sector has been telecom, down around 2%. The question becomes whether investors should even worry about details like this.
We're long-term investors, and so what goes on in any particular week or month is difficult for us to extrapolate from. It probably is a valid trading mechanism, as any momentum-type strategy becomes. And that's really what I think the January effect is about.
In the end, no one really knows what the future holds for stocks, but the bulls are hoping historical patterns repeat themselves this time around. For Nightly Business Report, I'm Dominic Chu.